Hello and welcome to tonight's webinar titled Quarter 1 2012 in Review. I urge all of you listening in tonight to go ahead and ask questions throughout the broadcast, and I'll check back and forth with the main panel here to try and answer those questions as soon as I do see them. So please ask questions because it always leads to other topics that I try and hit on or at least touch on that I think will be to your benefit. My name is Brian Kahn. That is my email. And then you can see also down there dailyforextradingedge.com, where I post daily market commentary. I actually just posted a commentary that'll be up for review in the next few hours or so. So please check there every single day because that's a great way to stay informed of what's going on in the markets every single day. I'm going to fast forward very quickly to the last slide just so you can see some other information. We'll review this again, but really quickly, the next webinar will be on April 11th of 2012, so about 2 weeks from now, talking about long-term trading opportunities right here. But I just want to let you know what other help is out there right away. The IBFX education site gives you a lot of great information, and then you can see that Daily Forex Trading Edge, where I post almost every day in intraday market commentary. I also duplicate that at my own blog, so that's the same information there. One is just where I write, but also you can find that same information right on the Daily Forex Trading Edge website. All of these webinars and others that are conducted by other analysts for IBFX are held at the Interbank FX YouTube site, so you can just go to YouTube and then search for Interbank FX videos. Pretty easy to find. I have about 20 videos on there. And then finally, the IBFX Connect site, where I go ahead and try and give intraday commentary as well, and my handle is the Locals Take. So go ahead and take advantage of that because we're meeting every 2 weeks on these webinars, but this is a great way to stay up to speed intraday on what's going on. Like I said, there's some people that are just joining the room now. Please ask questions as soon as you have them because I think it's really, really important that I try and see them and get to them so we can touch on a number of different things. That's my email if you have any questions. And let's go ahead and get started into the meat of today's session. Before I do that, Forex is a leveraged product. I'm going to leave this up here for about 15 seconds. Please read through it. It's very, very important. I hammer on this all the time through the trading psychology in my market commentary and in these webinars. You must be trading with a plan before you enter any buy or sell for any foreign currency pair. I can't stress that enough. All right, so if you have questions about the full disclaimer, you can go to ibfx.com and read it, but obviously you all know that you're trading a leveraged product, that if you do it without a trading plan or without the right discipline, it can obviously be detrimental to your account size. An outline, I like to provide you with an outline of where we're going. So we're going to do a fundamental analysis review. We'll look at technical analysis and bring in those two so that we can see major trends going on that are probably driven by fundamental analysis. We'll link up the markets. We'll link up all of the financial markets are related. They lead to trading opportunities. They lead to trading opportunities all the time. That's one that I just put on the Daily Forex Trading Edge page just now, so that'll be up for review. So again, those relationships are helping people find trading edges, so I can't stress that enough, that understanding how all the markets are interrelated is something of importance. And again, we'll talk about that tonight. We'll talk about your opportunity, where I can work with you one-on-one as far as providing some information for your trading personality, which is very, very important. So we'll talk about that in just a bit and then do a quick review. So what's going on in 2012 so far, the past 90 days? We're about to close out the quarter on Friday, so we just have a few more trading days. What's going on? Well, improving USD data. So the world follows us, and I actually put us meaning USA. The world follows the United States, and economic data here has been getting better and better and better. There's a link to see this information directly from the education section in Interbank FX, but I can take you right there. I already have it loaded up, and that's forexfactory.com. It's a free website. You link there right from the website. This is an economic calendar. If you don't understand what's going on here, you need to. You should be reading my blog, the intraday commentary that I provide at IBFX Connect, because I'm giving it to you. I'm giving it to you free, but it's something that you guys have to start to understand and layer into a trading plan, because it's going to help you so much. So forexfactory.com is how you stay on top of economic data around the world, and it has been getting better and better and better. More importantly than that, as I jump back here to these slides, more importantly than that, there's a bigger driving force, and that is the central banks from around the world are getting together and propping up the equity markets. They're saying, we're here from you. The Federal Reserve here in the United States, the Bank of England, Bank of Japan, European Central Bank. Obviously, everybody knows what's going on in Europe with the austerity measures. There's basically been government intervention to say, we need the stock market to go. We need the economy to get better. So you have to take this data with a grain of salt, because sometimes you may get poor data or data that's not coming in as good as we expected or as expected, and that doesn't matter. The markets are going up and up and up and up every day. So we have to realize that the equity markets are going up and up and up almost every single day, and we'll look at that. So the bigger piece is going over here and understanding when the federal chairman Bernanke speaks, or the federal chairman over in Europe or Bank of England, wherever it may be, you should understand what they're saying. You can do that here at the Federal Reserve Board of Governors page here, federalreserve.gov, again, another free site, and this is just their statements. So it's exactly their wording, what they're saying, so that we can understand it. And like I said, the major theme has been the governments around the world are here to support the markets, no matter how bad the economic data is, no matter how stagnant that economic data is, they're here to help. All right, so that means a couple of things for us as traders. So just so we can wrap up this slide in the fundamental data, things are getting better, but they've also been buoyed by the Federal Reserve. And remember, as traders, we always like to look ahead, and we're trying to see and guesstimate where the markets are going to be, whether it's 1 minute ahead or 1 year and ahead. We're obviously calling the direction of it. That's why we're trading and trying to make money from the markets. We're trying to be right. So we're looking ahead. So the major question I have for you as I go into the stock market, and you look at this chart and we focus on percentages, okay? So let me just bring up this chart here and make sure it loads for you guys. This is the United States S&P 500. So it's a benchmark index here in the United States. And percentage-wise, you can see that it's gone from 120 all the way up to about 140. And that's just about since this year. So just in the past few months, quarter one, we've gone maybe about 124, 125 to 140. So that's a $15 move in 3 months. $15 of a $125 index is about 12%. So in 1 quarter, the equity investments, that people's equities, whether they're mutual funds, whatever that may be, their investments, for the most part, if they're paying close attention to the benchmark, if they're mirroring or tracking the benchmark index, they've made about 12%. That's a very, very, very good year. Over the past 30 years, the markets have returned about 10% per year on average. We've already done 12% in just 1 quarter, and that 12%, as you can see right here in January, has been on top of a larger percent as you go back further and further and further. And so we know that for the past 3 years, the markets have been going up and up and up, but they've gone up very, 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 very steeply over the past few months. The question is, can that be sustained? Even though the Federal Reserve and the central banks around the world are here to help us, the question is, have we priced that in? And that's always the question for the markets. Have we gone too far? Have we not gone far enough? That's the question. So far, based on understanding some simple technical analysis, the trend is still up, and that hasn't changed yet. Until the trend changes, until there's a fundamental or technical shift, we have to be bullish equity markets. We can put on another chart, and you guys have heard me talk about this a lot in the past. VIX, which is a volatility or fear or uncertainty gauge, as the stock market on the bottom here goes up, the VIX or volatility gauge goes down, meaning when things are great in the stock market, which they are right now, meaning they're great in the world, people don't think that there's much reason to be very, very active in the markets. And so that, I'm not saying that there's not great opportunity out there. I'm just saying you have to be realistic as far as how many times you're going to get the opportunity to trade. When we have volatility in the markets, you might trade 2, 3, 4, 5, 6, 7, 8 times in a day. Right now, you might trade 1 time a day, 2 times a day, 3 times a day, 0 times a day. Every day is a little bit different. All right, and that's what I was writing about in my intraday commentary today, that today was a pretty active day in the markets and there was more opportunity. So every day is a little bit different. You can't walk into the market saying every day, I'm going to trade, 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 trade. You say, I'm going to approach the markets, and if there's an opportunity, I'm going to trade. So I just want you to understand what's going on with volatility or interest in the markets, or conviction of someone saying there's a lot going on, I'm going to be a buyer or a seller due to my trading plan, but I know there's a lot going on, so there's a chance for moving. This volatility gauge is saying, you know what, there's not that much chance of things moving because everything is fine out there and everything's kind of just hanging out. You know, things are great. Let's just watch our investments in the stock market and the economy get better and better and better. It's been working. The economy has been getting better and better and better. That may change tomorrow. That may change next year. We'll know it. We'll see it. We'll feel it, and we'll be able to trade accordingly. All right. So whatever the Federal Reserves around the world are doing, it's working because the markets are going up, the equity markets, and that's what they're trying to do. They're trying to stimulate jobs, they're trying to stimulate an economic recovery, and they're trying to stimulate positive growth around the world, and that's happening, and people are making money from their investments. We go back into these slides. All right, so we understand what's going on with the review of Q1 2012, what's been going on over the past 60 to 90 days, almost 90 days, and now the question is, we need to look ahead. Do we still see things as being as positive? Are the Federal Reserves around the world still doing what they've been doing in the past? And so until they stop doing what they've been doing, that's what I mean by until something fundamentally changes, we have to approach the markets like we have been over the past 30 to 60 to 90 days. If the fundamental change comes, then obviously we'll approach the markets differently. But until something changes fundamentally, we're going to approach the markets the same we have in the past. We'll look to see what happens next. We're going to constantly look ahead and wait for changes to happen. So the fundamental analysis there, we discussed the current events and what they mean for traders and investors. Very, very good for investors. Okay for traders, but not the best markets to trade in. Obviously, still good markets to get returns in that usually are above other investments and things like that. But the bottom line is it all depends on who you are and how much time you have in your individual situation. But the point is these aren't as volatile at times as we've seen in the past, and we will probably hopefully see in the future. We use Forex Factory to look at what's going on. You guys probably have access to TV around the world, and CNBC is a very good way to stay on top of the markets and the market moving events. Bloomberg is another website. It's a television station and a website. And like I said in the beginning, your broker has great, great information, and then other market sites. You've got to be staying on top of the fundamental analysis. You've got to know what the big, big drivers are out there. And right now, the big drivers out there are the governments stepping in and saying, we're here for you guys. We're here for the equity markets. We're here for the economy. You've got to understand that. All right. And like I said, I try and simplify that and break that down through my intraday commentary and my intraday posts and things like that. You can find it very easily. It does not take a lot of time, but you have to know what's going on. Technical analysis, what are the traders doing with the fundamental news? Major trend, support, and resistance. Major trend is up in equities. Major trend is down in the volatility gauge. You can't really bring in support or resistance because it's just trending, trending, trending. Support and resistance is a range. So now that we understand what's going on in the equity world, where everything's perfect and the volatility and the fear and uncertainty is low, let's go and relate that over and see what's going on in the past 90 days or so in our foreign currency markets. Okay, so let's bring up a couple of the charts and we'll just run through them very, very quickly. I'm going to blow these up and just go through these one at a time. So on a daily chart, this is the pound versus the US dollar, and here we go. Here's the 1st of January, right around here. We had a little bit of a dip, and then ever since then we've gone from 1.52 as a low all the way up to about 1.60, 1.59, so about 9 or 10 penny, about 8 or 9 pennies to the upside, 1.52 to about 1.59. So about 8 or 9 pennies to the upside. And right now, until today happened, we are basically right on our highs. All right, we had a high here at 1.5920. We had a high here, 1.5980, and yesterday's high was 1.5964. So we were right up there in that area, and then we had a down day today, and we'll talk about that. So overall, the pound over the past 60 days has been stronger against the United States dollar. All right, let's look at the euro over that same time frame. Here we are again in January. Right here, we had the same little dip, and then we went up, 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 and then in the month of March, we've gone down a little bit and kind of back up. So right now, the pound is on its high. As of yesterday, it was on its high over the past 3 months, and the euro is a little bit off its high, so you would say that the euro is a little bit weaker. If I brought up a euro-pound chart, you would see that the euro is going down against the pound, and it's very easy to see that against the United States dollar, where the pound is almost on its highs and the euro is a little bit off its highs. Obviously, we know what's been going on in Europe, a little bit of help from their governments and things like that, where that might be weakening the currency, or obviously is weakening the currency a bit. Still strong against the United States dollar, not as strong, though, where the pound is concerned against the United States dollar. All right, let's move into our next currency over the long term. Let's look at the Australian dollar versus the U.S. dollar. I'm going through the U.S. majors here. Okay. Here is the chart as of the 1st of January right here. So we've gone up, 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 up. We went from 1.01 all the way up to about, and I'm going to move this panel here, about 1.08. So a nice big move up and then a big move down. We'll talk about this, so we could bring up intramarket relationships just to show you, because these are important. I'm going to close this down, and all right, I'm going to close this down. Sorry about that. Let's bring up another chart. Okay, here's the gold chart, and I'm going to close this down so you can see it on a bigger time frame or a bigger view. Let's close that down. So here's gold. Gold has gone very sideways. Here's 2012 right here. It went up and then kind of down. This chart right here in these few months looks pretty similar to this chart going up and then down. So that's what I mean by intermarket relationships. So that's a look at gold, or at the Australian dollar, comparing it to gold, those intermarket relationships. Let's look at the New Zealand. New Zealand doesn't have as many commodities per se as Australia, but it looks eerily similar. Here's the first of the year. Up, 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 sideways, and a little bit down. All right, so overall, the United States dollar has weakened against 4 currency pairs over the past 3 months as the United States dollar has gone up. Let's flip things around and look at the U.S. versus the Canadian. So if the U.S. is getting weaker, this chart is going down. Here is the first of the year. A little bit of a dip in the United States dollar as the, strengthening the United States dollar, and then the United States dollar gets weak, 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 weak. All right, let's go back and compare that to intermarket relationships. Let me bring up another chart. USO. This is tracking oil prices, and oil prices since the beginning of the year, right here in January, have gone sideways and then up, 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 and then a bit sideways. So overall, oil prices have gone up, and overall, the Canadian dollar has strengthened against the U.S. dollar. So we are 5 for 5 U.S. dollar weakening when the stock market has been going up for the most part. Our final one, the U.S. against the Swissy, and obviously the Swiss don't have a lot of commodities either, so this is kind of its own entity. Here we are in January, and the U.S. has weakened just a little bit, not too much against the Swiss franc, but again, the U.S. has weakened. So 6 for 6. So these are the fundamental drivers. Ben Bernanke, our Federal Reserve Chairman in the United States, has said we want to keep the U.S. dollar as the weakest currency out there. It makes sense every time he speaks that the United States dollar loses strength. The last time he spoke was Monday morning. All right. He spoke Monday morning and he said, I want to keep the US dollar weak. He spoke right here, right on this bar right here. Let's see, 2 noon. He spoke right about here. The pound was already going up in anticipation. He spoke right here, and it went up again, more than double that move, and the pound went up, 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 up. So he is saying, I want to weaken my currency. The pound isn't saying we want to weaken our currency. The Bank of England isn't saying that. So when you get that, you understand what that policy is. Yes, we've given back some of those gains, but that's actually a function of the stock market and the relationship out there. So when the stock market around the world, when equity markets go down, the dollar, the US dollar, becomes a strong currency. So looking at this on a smaller time frame, today was a big down day in equities around the world, and the pound lost value to the United States dollar. This is exactly what I wrote my blog about today, so you've got to read it because it'll make more sense when you go and read it if you pay attention day after day after day. Late in the day, the U.S. equities started to go up. The pound started to go up. There's a relationship between the pound going down when equities going down. Look at all currencies and what they did against the dollar today. We're used to seeing the dollar getting weaker as equities go up. Now look what happens as today the equity markets went down and the euro lost value against the United States dollar. Looks exactly the same as the pound trade. Let's look at the Australian dollar on that same time frame. Here it is. The United States equity market went down. The Australian dollar went down. The United States equity market strengthened in the afternoon. The Australian dollar strength in the afternoon. 3 for 3. If you look at the New Zealand, it'll be very, very similar to that. Okay? I'm not saying that these relationships work every time. I'm not even saying these relationships are there every time. This is for educational purposes only. This is past performance. We can't guarantee what will happen in the past. But obviously today there was a relationship at work that if you understood it, you may be able to be on the right side. Obviously early on it was a trend down in any currency against the US dollar. That changed and we went sideways to up with as far as the currency that was paired with the United States dollar. Flip things around, here's the United States dollar. If it's getting stronger, it should be going up today. And here you have it going up today against the Canadian and then sideways and then back off a little bit. Let's look at it against the Swissy on just today's time frame. Did the United States dollar strengthen against the Swissy? You bet. Strengthen, went sideways. All 6 currency pairs are trading exactly the same or similar on a long-term scale, and they're trading similarly on a short-term scale. That's what I mean by understanding the fundamentals. If you understood the fundamentals and you were paid attention to Bernanke and him speaking on Monday, you wouldn't have gotten caught going against this move. He said something that caused the equity markets to go up almost 200 points in the United States, 2 or 3%, and obviously the pound followed suit by getting stronger. Today the markets went down almost 1% at one point, and the pound lost value at that same time. The markets recovered in the United States equity markets, and the pound recovered. So these relationships aren't around all the time. They're not perfect, and they don't work every time. That's why we put a trading plan together. I think this is going to happen. I put my entry in here. I put my stop in here. I put my target in here, and I manage the trade from beginning to end. That's exactly what I talked about in my market commentary today. You need to be using these relationships. If I can bring up the stock market today and bring it up on a smaller time frame. So if I can bring it up on a 15-minute chart, look what it did today. It went down, 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 sideways, and then up, 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 up. Does this chart look exactly like this chart? Down, 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 middle of the day or middle of the American day, equity session, up, 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 up. That's pretty nice to be able to see those relationships when they're in play and be able to make trading plans off them. Sometimes they're not in play, and sometimes the equity markets or the Forex markets are doing their own thing, and maybe there's something going on around with interest rates that are affecting the Forex markets that aren't affecting the equity markets. Maybe there's something affecting the equity markets that aren't affecting the Forex markets, and you don't get something to lead and tell you what, a trading plan. So it's not always there, but the point is, if you guys understand fundamental analysis, if you guys understand technical analysis, you can paint this picture and put it together yourself. This isn't brain surgery, but it does take work. Hopefully this helped you tonight to see the forces at work. Until fundamentals change, the equity markets are going up and the Federal Reserves are there to back it up. Until technicals change and you see some separation or disassociation, that relationship has kind of roughly been in play. Your opportunity. This is your opportunity to talk with me one-on-one via Skype or via phone, where I can help you learn a little bit more about your trading situation when you're trading throughout the day, how many hours you're putting in throughout the day and what type of trader you should be, how many pips you should be risking, what time frames are available to you given your lifestyle, given your time and things like that. Like I said, most important, the right amount of pips and things like that and contracts to use for your situation. Everybody pays attention to the markets at different times. Everyone puts in different hours. We all have different things going on in our life. If you don't understand how to do this for yourself, that's where I come in and I help you. So it's your opportunity to do what I call an engagement interview, and you can learn a little bit more about your individual system. If you don't understand your individual system, I do think that the markets will be hard for you. Once you can hone in on yourself and cut out all the other stuff that doesn't matter to your situation, I think you have a much better chance of success. So to review, we talked about fundamental events, what's going on in the past. We're looking for them to happen in the future or for them to change in the future. Through central banks around the world, through the economic calendar. Technical analysis, we looked at trends going on in equity markets. We look at trends going on in foreign currency markets. We look at similarities between those markets and to find those intermarket relationships to provide trading edges. They may stop tomorrow. Who knows? There'll be other things to move on to, but at least you know that they're not working, you don't use them, and you move on to something else. We're always adapting. We're always flexible as traders. So that's the Q1 2012 in review. I don't know where we're going next, but I know that I'll be able to react to it and trade what's going on next when it happens, because I'm always updating myself. Just like you read a page in the book and you learn information, then you change, and then you flip that page. Read another page, you learn information, flip that page. Whether you're trading for minutes or you're trading for hours or you're trading for days, you've got to update yourself each and every day, each and every trade, to be able to manage it to the best of your ability and trade with a good trading plan. We are always constantly learning new information. If you're not keeping up with it, if you're just turning on the computer after you woke up and make a trade, I think you're going to have a tough time being successful. This takes work, you guys, to layer on top over and over and over. So again, this is the first slide I showed you. The next webinar in a few weeks, we're talking about longer-term trading opportunities. I think you obviously saw some long-term trends in play, but we'll talk about long-term trading opportunities. We'll also talk about the regular fundamental and technical analysis that we talked about today. So 2 weeks from now, has anything changed? You'll be updated. If you don't want to wait 2 weeks, go ahead to Daily Forex Trading Edge, where I write almost every day. Go into IBFX Connect and go to the Locals Take and follow me, and you'll see some intraday comments as well. Let me check back now as I've kind of run on and on and on with some questions. All right. This seems to be my biggest problem. I let myself get sucked into short-term trading, but I prefer long-term range trend trading. It just comes down to discipline. I don't know who you are. I don't know what's best for you. I'd be happy, to help you if you have any questions for sure. You can always reach out to me via email, but keep in mind, that comes down to your discipline and saying, hey, I'm a long-term trader. I'm looking for a longer-term opportunity. There are long-term opportunities out there. I'm pretty sure it was on the euro. So if I flip back to the euro, let's see here. I just have to move this panel here, so sorry about that. Okay, look at the euro and look at it on a long-term chart. This was a trade that I talked about on the market commentary. Look at this opportunity here. I love Fibonacci retracements. The euro went from 1.25 to 1.35, went 10 pennies. Big move or small move? That's a giant move. We know that. That's 10 pennies. It's 1,000 pips. It's giant. And then it went down, 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 down. The equity markets during this time were going up, 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 up. Bernanke saying, I want to weaken, I want to weaken, I want to weaken my currency, the United States currency, and the euro is going down, 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 down. If you think the euro is going to get stronger, what a great place to get into it at a 50 or 61% discount to where it just was. It goes 1.35, 1.34, 1.33, 1.32, 1.31, 1.30, 1.29. Look at this old support right down here. You've got a Fibonacci. that's a long-term trading opportunity. You may risk 100 or 150 pips and put your stop here and try and go for 200 or 300 pips. But if you're not letting yourself see those and worrying about a small move of 10 or 15 or 20 or 30 pips, and that's not your trading style because you don't have the time to be in front of those markets, yeah, that's going to start to hurt you. You've got to start to set some very, very, very strict trading guidelines for you. These markets aren't the easiest to be trading. They are providing great opportunity, but you've got to be true to yourself. All right? Let's see. So hopefully that helped. I have plenty of experience and know better, just need to discipline myself better. So I didn't even see that part of it. So there you go, everybody. Discipline, discipline, discipline. I've been doing this for 14 years. I work with other people and teaching them. I still have to do discipline, but I'm lucky to be in a position where I help others, and helping others keeps me more accountable to myself. So it's a win-win for me, trading and doing analysis and teaching and coaching and stuff like that. Look, some people want to run a marathon. Some people want to lose weight. They hire personal trainers. They hire coaches. If you want to, be on a great soccer team, when you're a kid, your dad's going to go out there and get you a coach, obviously, and work on your left foot, because you're right-footed, whatever it may be. Some people just need that help, and that's what I feel like I'm very good at, it is helping others. I have a very good broad view of the overall markets, and so I try and give people more of an education, not just foreign currency, but how they're all interrelated, and open their eyes a little bit more. I'm long-term short the euro. I believe recession is going to last years in the EU. I don't know if I can argue you, but again, fundamentally, if they keep bailing things out there, then things may not get worse for the euro. We don't know. So you have to use the charts. If you're fundamentally saying things stink around the world, I'm going to get short the equity markets, you're wrong day after day after day after day. I don't know where you're short from. Hopefully you're short from up high, but trends can run forever, for a long time. There's nothing to say the euro can't be back up at 1.5 to the U.S. Please use the charts and make a trading plan. Fundamentals are great, and I stress that you use them, obviously. That's what we're talking about tonight, but you can't use them alone. I'm currently short near the top of the head you just drew the fib on. Perfect. So good job. You obviously have some gains, and they've obviously came back, so maybe you took some profits off, maybe you've moved your stop. That's just like today's trade. If you looked at the trade over the past few days, same kind of thing where you had this kind of little top, and if you thought the stock market was going to roll over, maybe the euro would roll over because there's that relationship, and today was a big down day. It's climbed back about 50% or so, just like the pound did, and so you want it to stay here and have resistance and roll back down. But if you originally got in right here at the top and your stop was above it and your target's down here, then obviously as it goes down your way, you want to start to move your stop down, move your stop down, move your stop down, move your stop down, lock in profits, because as it starts to retrace higher and higher and higher, it has a better chance of shooting up. So hopefully you're using management, and day to day to day, as I said, you're a longer term trader. You're saying things aren't changing, stock market's going down, euro's going down with it, relationships intact, and you're okay. If the stock market goes up to the moon tomorrow because all of the Federal Reserve said we're here to help you out, and the euro jumps up, hopefully you've moved your stop to protect that. So constant money management. So good job with that trade. Let's see. All right. To me, the euro is in a long-term downtrend. If it goes over the, okay, so the person who I was just talking about, they have a stop in place above that. So again, hopefully we get another leg down for you. If the markets keep going down, that relationship stays in place. We'll see, but nicely done. Someone else said I'm long-term short or think that it's in a downtrend. Again, I don't know what long-term is. I don't know where you guys are coming from, but yes, it has been in a long-term downtrend ever since last summer, right around here. We had all of that trouble going on in Europe and originally started. Yeah, it went from 1.45 all the way down to 1.25. So yes, it's in a long-term downtrend. Big move down, small move up, big move down, small move up. Is there another leg in store? Maybe. We don't know. Obviously, there's intervention out there and austerity measures and relationships out there. We'll continue to monitor. But overall, this has obviously been an area of resistance where the person I was just talking about has maybe a left shoulder, a head, a right shoulder, and will it roll back down here and take out this low? That's a very, very, very long-term trade where you're trying to make 4, 5, 6, 700 pips. You've got to be willing to risk 3, 4, 500 pips to make 6, 7, 800 pips. Keep the risk reward the same. So these are long-term trading opportunities, the stuff I'll be going over in 2 weeks. So good job, guys. Well done seeing the overall trend. Well done seeing some technical patterns. That's exactly what I want to hear from you guys, and hopefully you're trading them well and continue to manage them. So let's wrap up here. I thank you guys for your questions. Very, very good job. Let's see. Sooner or later, the 3 million of should have an impact. Looking for 120. Yeah, so this is someone just calling out that they're looking for 120 in the euro. Could very well be. Again, trading plans in place, understanding trends, understanding fundamentals out there. Yeah, if it goes to 120, that's a big move. That's lots of volatility. Everyone's going to be happy as traders, and that's the stuff I'm talking about. I have a feeling though, until we see the stock market start to back off due to whatever it is. Is it bad earnings? Is it a problem in Iran with the oil complex? Is it something else? Is it Israeli and the other Middle East tensions? Who knows? But obviously that's the stuff as traders that would start to key us in and say, hey, things are starting to change. I've got to be in front of the computers more often because I'm going to probably be trading a few more times now because there's other things going on. Looking for 120 trillion. Yeah. So we'll see what happens, you guys, out there. The point is there's a lot of headwinds coming, I think, and a lot of stuff to still digest, whether it's in America and our interest rates, whether it's in Europe and austerity measures. Point is, if you're trading well in these markets, you'll probably trade well in those. If you're not trading well in these markets, make sure you really step back and say, what's going on here? What are the opportunities? What am I trying to achieve? So just going back here to the slides, if you guys do have any questions, as far as ongoing education, here it is. Look forward to seeing you guys. Sounds like you guys are a group of really educated traders out there. Hopefully I'll see you on future webinars where you can ask questions like this. That's my email if you have any questions. Thank you very, very much for your attendance. Thank you very, very much for your participation. That's what makes it great, so I do appreciate it. And I look forward to seeing you in a few weeks, if not on the IBFX Connect and the daily market commentary site between now and then. Thank you. Have a great evening or a good morning, depending on where you are at. Thank you, guys.